Hello and welcome to Ensuring Success 2018. We're so glad you're with us today. We are live from AMS Pictures in Dallas, Texas, and we're about to start the section on tax reform. But first, I'll introduce myself. I'm Gail Perry, Editor-in-Chief of CPA Practice Advisor magazine, and I'd like to thank our sponsors for this event because we couldn't do this without the help and support of our sponsors. So they are Sage, Xero, Avalara, Boomer Consulting, Canopy, CPA.com, eFileForBiz.com, Peisner Johnson, Receipt Bank, and Intuit ProConnect. And we in particular would like to thank Intuit ProConnect because they are the specific sponsor of this session. And this session is about tax reform. Before we get started, one more thing, let me just mention to you, if you have not been with us earlier today, how to get your CPE code or how to get your CPE certificate for this event. What we will do is post 3 codes during the session. They'll appear at the bottom of the screen. Each code is a 3-digit number. And when you see the code, and I'll call attention to it when it's on the screen, you need to write down that number. So at the end of the session, you'll have 3 3-digit numbers related to this session. At the end of the day, when you're done watching all your sessions, you'll go to the top of your screen and look for the Get Your CE/CPE Credit tab at the very top. And when you click on that, you'll see the list of all of our sessions today and a place to enter the codes for every session you attended. So hang on to today's codes, and then at the end of the day, you can get your CPE credit and you'll get your certificates right at that time as well. You can reach us online today through social media and email. We are on Twitter at #DecemberCPE. We're on Facebook on the CPA Practice Advisor website. And you can reach us through email if you have any questions, issues, concerns, just want to say hello, at info@ensuringsuccess.com. So that's how you can find us here. And we would like to get started with this session. I'll first introduce our speakers by name and have them tell you a little bit about themselves. So next to me is Jackie Meyer, and next to Jackie is Mike DeVolio. And I'd like to have you tell us a little bit about your backgrounds.
Sure. Hi, I'm Jackie Meyer. I own a small public accounting firm here in Southlake, Texas. And we specialize in tax strategies. And so tax reform has been quite the opportunity for us and our clientele.
Hi, Gail. Thanks for having us.
Welcome.
My name is Mike DeVolio. I'm a CPA, and I work at Intuit. Before Intuit, I worked in public practice many years ago. I'm a tax law specialist with Intuit, and currently I write a lot of articles both for our Tax Pro Center as well as media bylines, and I also do a lot of training for tax professionals, both on tax law changes as well as product changes.
All right. So y'all might have heard this year that there was some tax legislation, pretty significant tax legislation, originally I think designed to lower corporate tax rates, and then all of a sudden it impacted everybody. So no matter who you are, we think you're probably going to be impacted by the new tax law. So we're just going to jump right in, and I think the plan is to start with changes to the individual taxes and talk about the changes that most of which you may have heard of, may not know exactly what to do about yet. And in fact, some of those changes are still kind of being discussed around Washington, D.C. So we hope that there'll be news on some of this stuff before the end of the year. But we'll let you know what we know about the tax law. So Mike, would you like to start?
Sure. Gail, it's the tax reform package, Tax Cuts and Jobs Act. It represents the largest piece of legislation that we've seen in 30 years. So a huge bill and a large impact. So it provides broad relief for both individuals and small businesses. And one stat that the government threw out is that a family of 4 with an average income of around $73,000 can potentially get a $2,000 tax break.
Okay. Now the tax form itself, should we start with that? Because there seem to be some major changes to the way our tax form is even going to look. So I imagine that's right out of the gate, we're going to be explaining to our clients what the new form looks like.
That's right. What we have on the graphic here on slide number 2 is the new 1040 postcard. And it does replace all prior versions of the 1040, 1040, and 1040A and 1040EZ. What you have is a postcard and really 2 halves of the 1040, and then also 6 supplemental schedules. It also does not replace the ancillary schedules that need to go along with it, like a Schedule A or Schedule B.
Yeah, simplification at its finest, right? So we have a lot of challenges to overcome this year with not only the new tax reform to deal with, but also the new look and feel of Form 1040s. So it's going to be quite an interesting season.
Yeah, I think so. All right, let's start with tax rates and brackets, because that's certainly going to affect every individual tax filer. So what have we got new in that area?
Yeah, what we have is the government kept the same number of tax brackets, but on average, those brackets have come down by about 2 percentage points each. So that provides relief. And then secondarily, what the government did was widen the tax bracket. So that provides basic relief as well.
Yeah, there's a pretty big hop around the same numbers or thresholds that we have to deal with, like with the new QBI deduction, which I'm sure we'll talk about more. But once people get into the married filing joint, 315K, or married filing separate or single, 157.5, there tends to be quite a little bit of a hike there in the tax rates as well.
And one of the call-outs for when you're talking about tax bracket reduction is that the government would have, back in February, they issued new withholding tables that companies would have incorporated into the paychecks of citizens. So basically, you've been receiving part of that tax break throughout the year. So you come in the spring when you file your return, you may not see a bottom line reduction, but overall, you would have been receiving a piece of that break throughout the year.
Okay. And what about exemptions?
The personal exemption has been taken away. That was up to like around $4,000 for each person in the household. But you have to be careful. You say, well, they took that away. But on the other hand, there are some offsetting measures. Like we'll talk about it in a bit. The standard deduction has been escalated. And you look at the child tax credit, and that's been increased as well. So it's really, you can't really look at each item necessarily in isolation. You have to look at the broader picture.
Yeah, the standard deduction doubled, which is pretty handy. And then the credit got expanded to where people in higher income brackets can take it, which is really nice.
All right, let's talk about the child tax credit. And especially, I think there's some concern about, well, if they've done away with my exemptions and I've got 6 kids, I was really counting on all those exemptions for my kids. So how does that all work in conjunction with the child tax credit changes?
Yeah, what they did was the government doubled the child tax credit from, it was $1,000. They bumped it up to $2,000 per child, and $1,400 of it is refundable, whereas under the prior law it was $1,000 only. And as Jackie mentioned, the thresholds, I think they were around $100,000 of AGI. Folks underneath that level could claim the credit. Now they bumped it all the way up to $400,000 for a joint return. So many more people are going to be eligible to receive that child tax credit.
Yeah. Most of my clients are high net worth, and so they were not getting the tax credit, and they were not getting the exemption anyways. And so it actually made it to where they're actually doing pretty well with the new rules. So.
Excellent.
And there is one footnote there, too. The government also put in place an ancillary $500 credit. So for for children that don't necessarily qualify for the child tax credit, they may be eligible for this $500 credit, and it's part of the child tax credit package.
Okay. State and local taxes, where are we with that?
Big changes. The government put a cap of $10,000 on the amount of state and local property taxes, income taxes, sales taxes that you can normally take.
That whole section of Schedule A.
Yeah.
That's right. There's a cap of $10,000 that you can take on Schedule A.
Yeah, so there's quite a bit of limitations there. There's all kinds of talk planning-wise as to, should I move my property into an LLC and then rent it to myself? But then, of course, you would lose the, Section 121 exclusion on selling your home if you had it as a rental. So there's all these little theories out there and whatnot. There's things with the state income tax, states trying to get around having to claim it on that schedule or moving it to like a charitable deduction. And we just don't have answers yet as to how that's going to pan out. So every firm's really going to have to kind of choose their stance as to how aggressive or conservative they're going to be with that area. Here in Texas, real estate taxes are high. So all of my clients are, getting capped out to where the sales tax doesn't even matter anymore, and their real estate taxes are more than $10K, so that's the max they're going to get. But overall, with a doubled standard deduction, you actually don't see a huge change in the decrease in like about 2% in rates, like you were saying, with the marginal brackets. So the people that are really upset are the Californians. Because I had a client that owes $300,000 a year to California, and that is now capped at the $10,000.
Oh my gosh. Yeah, that would be upsetting.
Yeah.
All right. Since we're on Schedule A, we've had some changes also in the home mortgage interest deduction area and also home equity line of credit interest. So let's talk about all that.
That's right. So two big changes there. Number one is for mortgages that are taken out in 2018 and forward. The old cap was $1 million on the amount of the mortgage and then the associated interest deduction. So they took a cap of $1 million and brought it down to $750,000. So that's one big change. And then also for home equity loans, what the government said was if proceeds from a home equity loan are applied towards the home, such as putting in a new kitchen or a new bathroom, it's still going to be deductible, and that would come under either the $1 million or the $750,000 cap. However, if the proceeds are used for personal expenses like paying off a credit card or paying off an automobile loan, then those are no longer deductible, regardless of when that home equity debt was taken out.
Unless it's used towards business expenses, then it would be a business deductible item. Yeah.
Okay, and we have a question coming in from the audience. Did the holding period change to gain the full exclusion of $250,000? We're talking about home sales.
Home sale. I don't believe so. I believe it's still $250 and $500 for single and married filing joint.
Okay.
Yeah.
Okay.
And there was talk about the holding periods changing.
The holding period, yeah.
There was talk about that in some of the prior legislation or pending legislation, but ultimately in the bill that passed, they retained the same holding periods for the home exclusion.
Okay. All right.
Now, it is good to note, though, that you are grandfathered in, so to speak, if you don't refinance or purchase a new home. So that's what Mike was referring to in regards to still getting the $1 million, which is actually, is it the 1 or 1.1? Because it was 1.1 with the home equity. So I'm not exactly sure how that's going to work out, but it's either that or the 750 cap. And then if you refinance between this beautiful period of December 2017 and April 2018, you could still actually get the old mortgage rates if you didn't change the terms of your loan. So there's a lot of little ins and outs to that one.
Okay. Sounds like it's complicated and
Yeah.
and still a little bit in limbo. And the 2% miscellaneous itemized deduction. What happened to that?
It's
Where did
gone
it
away,
go?
for federal anyway. States, it might still be around depending on whether your states conform. And that's true across the board. We're talking about federal changes here. So states, it's going to be on a state-by-state basis. Some have conformed, some haven't. But on that particular provision, the 2% itemized deduction is gone, and that applied to deducting your tax preparation fees, investment expenses, employee business expenses. So that is no longer on the books.
We're going to come back to that in just a second. First, I just want to mention that your first CPE code is appearing on the bottom of your screen. It's a 3-digit number, so be sure to write that number down. That's the first of 3 codes you'll be getting during this session that you'll need if you want to claim CPE credit. And also, this session is qualifying for CE credit with the IRS, so at the end of the session, when you go to fill in your CPE form, there's an option to click if you need CE credit, and we'll ask for your PTIN number there. So if you who have questions about how that's going to happen, that's how it's going to happen. So, all right, let's get back into the business expenses, in particular the 2106 expenses that were coming up on the miscellaneous deductions. Is there any potential relief for that? Any way to plan around the loss of that deduction?
I'll let Jackie talk about accountable plans.
Yeah, I love that one. So, I mean, hopefully you're already allocating things like tax prep fees to other schedules where possible. That's really the name of the game now, is reallocating what may have belonged on Schedule A anywhere else that you can legally do so, which, you know, going back to state income tax, I don't think the letter of the law is really about allocating that to the partnership that it goes to or that kind of thing, but I keep looking for some kind of loophole there to try to make that work, because, I mean, moving state income tax from Schedule A 10K limit to unreimbursed partner expenses could be a huge thing for people. But yeah, the unreimbursed employee expenses, there's some opportunity there for employers to maybe offer some better home office reimbursements, look at tax-free fringe benefits they might be able to offer, so that employees are still getting some benefits out of unreimbursed expenses, but not having to be taxed on them fully. So that's always an option. And then an accountable plan, if you own your own business, I love accountable plans, because an S Corp or C Corp can set up this internal agreement with the owner and the staff and the company itself. It's not that official. And deduct directly on the S Corp or C Corp return the home office expenses and whatnot, without even having to file any extra schedules on the 1040, if it was even allowable anymore. So there is some opportunity there. It's interesting. I haven't seen as much movement with employers as I thought I would this year, with kind of trying to restructure and help employees out. But, you know, they're probably just trying to tag along with the rest of everybody else with what the changes are, and then maybe they'll catch up next year.
Could there be a flex plan option with an employer to cover these types of expenses, like there is for healthcare?
Well, I guess there could. I mean, I think it needs to fall under that accountable plan umbrella. So it really comes down to what the tax code was meant for, and I don't see them really, I haven't heard of talk of them like expanding it to be more flexible, but you never know.
Okay. All right, what about alimony? That's changed a little bit in terms of the taxability of it, deductibility.
Right. And it's going to actually the change is going to take effect beginning January 1st, 2019. So it's most of these provisions that we're talking about began to take effect in 2018 and forward. And by the way, the individual provisions versus the individual sunset at the end of 2025, whereas the business provisions do not sunset. But so this is, the alimony change takes effect beginning in 2019, and what it's saying is that for the person who pays the alimony, they no longer get a deduction, and that was the rule under the old law. And then the recipient will no longer report the alimony into income beginning in 2019.
Under any new alimony agreement as of 1/1/19 and forward.
Good point.
Yeah.
Yes.
So if you were paying alimony prior to 2019, you continue deducting it, and the income is taxed the way it was in the past. Okay. All right. What about the Affordable Health Care Act penalty?
Well, the penalty's going away as of 1/1/19 forward. So everyone's kind of in limbo with that, right?
Right. That's going away. The rest of ACA is sticking around, so we still have the marketplaces. We still have the premium tax credit, which is sort of a subsidy that helps people afford insurance. And then the employer mandate. Employers over 50 employees still have to provide insurance to their employees, otherwise they get hit with a penalty. So it's just the employee mandate or the individual mandate that's going away.
Okay.
Saw a huge shift of people switching to those third-party plans, you know, like Liberty Share and medical share plans over the last couple of years, which are interesting because those aren't deductible if you're self-employed under like the 1040
Right.
self-employed health insurance deduction. So you have to treat those a bit differently.
Okay. Okay, and then I think we have one more item in the individual taxes, well, it's not exactly individual taxes, but sort of, is changes in the estate and gift taxes this year, or next year.
Right. What the government did was, and I got to look up these figures because I don't want to get them wrong. So for estates and gifts, beginning in 2018, they basically doubled the exemption. So it's gone up to 11.18 million for single, and then for joint filers, 22.36 million for married couples beginning in 2018.
Yeah, what's unfortunate about that is that I'm seeing people with less of a reason or need because it's increased so much to want to do estate planning and trust planning. And I think it's really vital for pretty much anyone to have that in the works. So it is discouraging that with my clients, but you know, it's great that it doubled for the people that it'll apply to, I guess.
Okay. All right. If you are interested in contacting us during this session with any questions, you can reach us, as we mentioned before, through social media. You can reach us at info@ensuringsuccess.com. And you can also reach us on slido.com, which is what we've been using in some of the other sessions for polling. It's slido.com. And they ask for a code to get in there, and it's December CPE, the code. So you can go to any of those places if you'd like to pose a question, and we'd be glad to share those with our speakers today. So let's get into sort of the big issue of qualified business income, QBI, which everyone's talking about and not too many people understand.
Mm-hmm.
All right, just high level with qualified business income deduction. Basically, it's a 20% deduction for small businesses, and they say it applies to flow-through activities. Typically, we think of a flow-through activity as a partnership K1 or S corporation K1. Actually, applies to a Schedule C as well on an individual return. So it provides a 20% deduction. And there are some comprehensive rules that go along with this new tax break.
Yeah, it's all over the place. So there's no way to calculate it in the back of your head like an S Corp election. You know, I can wing that one pretty good if someone needs to be a S Corp versus a Schedule C. It's really difficult to wing it with QBI. And as we've been doing year-end tax plans for clients, you notice some really interesting things that come out of each plan. For example, I had an interior design company as a client that, you know, another accountant didn't even think about them being a specified service business, but I think they actually do fall into that category. And so what I honed in on for their $100,000 potential annual deduction for QBI was, you know, how do they fit into that safe harbor of where gross sales from like hourly design work is less than 10% of their gross sales, and they were 12%. Everything else was furniture sales, but 12% of their sales was actually from hourly design work, which I feel like that's the kind of the intent of the specified service business is, you know, are they charging hourly for their work, and is the person kind of the most tangible thing about that business? So then I really had to deep dive into how I was going to get them out of this specified service business thing, because it completely phases out the deduction once they get into that 315 to 415 threshold. And so what I actually found, and you know, again, this is something every firm is going to have to decide on their own where they stand. But if they are charging hourly for services, look at the balance sheet of the company and think about, is that person or the people the only asset of that company? So is there inventory involved? Is there software intangibles? If there's other things like that, I think there still may be a case to say that that, you know, is not a specified service business if they're really relying on inventory or furniture sales or other things. So there's just so much to it, and every client is taking several hours to figure out. And every software is different as to how you want to calculate it. So, you know, people will want to prepare, hopefully in December, for their clients, because there are some aspects of it, like wages paid, that you can't do a whole lot about after December.
Mm-hmm. So as you can imagine, we're getting lots of questions on this topic.
Awesome. My favorite.
All right. So Let's see. First of all, does QBI apply to rental properties for individuals?
Well, it has to come to a level of a trade or business. So however you want to define a trade or business, because that's a gray area. But going back to Mike's point about applying to Schedule Cs and whatnot, it also actually applies to passive K1 investments. So that is a trade or business at the business level. And so it's kind of a completely different way of thinking about how to apply it. But I don't have a super clear answer on that one.
Okay.
Yeah, and Gail, we're expecting some potentially further guidance from the IRS and the Treasury. They did issue some proposed regulations, and they did indicate that the business needed to rise to a level of a trade or business definition. And rentals can fall into that category, but we're expecting potentially a new publication as well as new guidance regulations that could give us some better clarity around, okay, rentals do qualify, but which ones? What type of, what level of participation do I need in order to qualify for the 20% deduction?
Okay. And here's a question around who's going to be calculating this. So will the amounts required to calculate the 199A deduction at the individual level be provided to the owner of the pass-through entity on a K1?
That's what we're hoping for, right?
Yeah, the way the K1s look right now is they're going to pass through 3 items to the individual. They'll give you a qualified business income number, as well as wages, W-2 wages, and also an adjusted basis in the property. Those are kind of the 3 important components. So we see the K1s passing those numbers through, and then the individual at the 1040 level needs to go through. There's kind of 3 big limitations, and we can bring them up on the screen. There's a taxable income limit, a service business limit, and a wage/asset limitation.
Okay. All right. Let's go back to a few more of the things we want to be sure we cover in the tax law changes, and then we'll get back and pour over some more of these questions. So, so don't stop asking your questions because actually, even if we don't get to all of them today, I can send them to these guys and you can get answers later. So we can make that happen. So don't stop asking if you've got questions, but we'll get to more of them in a little bit. So let's flip over to business for a little bit and talk about depreciation, because that's another really big area of the tax law changes.
I'll cover it at a high level. We already had pretty generous depreciation expense deductions. Government definitely upped the stakes even more. So in 3 categories, bonus depreciation was already at a good level of 50%, where you could write off that in the first year of purchasing. They bumped that from 50% all the way up to 100%, so you can write off the asset. And used property now qualifies. Second category, 179, they doubled that limitation as well. Used to be a $500,000 level. They bumped that up to $100,000 or $1 million that you can write off in the first year. That's kind of an ancillary provision where it allows you to write off the cost of the asset in year 1. And then the third category is vehicle luxury auto limits. They basically triple those limits, and that represents the amount that you can write off in the first year for vehicles.
And a lot of those changes actually took place, I believe, September 26th of 2017. And so I'm a little worried that some of our profession overlooked that when they were preparing 2017 returns and overlooked some extra deductions and certain strategies they could have gotten for their clients. But, you know, it's something to maybe take a look back on again.
There's always amended.
Yeah, there's true.
And one footnote on depreciation, I think you have to be careful. We have these generous deductions, right? You have to be careful. Number 1, can you fully utilize these deductions? You're writing off these potentially expensive assets, and if it throws you into a net operating loss situation, you can't take it in year 1. Self-employment tax, you wouldn't benefit from it if it takes you below 0. And then the third thing is, what does it do for qualified business income? If it's going to bring your QBI level down quite a bit, then you're not going to benefit from that deduction as well. So you have to be careful and plan out accordingly.
Right, and also if you're expecting much more income next year, you may want those deductions, you may want to spread those deductions out instead of taking a
Correct.
bunch this year. So lots of great opportunities for accountants to do a little bit of forward planning with their clients on that.
Oh, yeah.
Okay, let's hop over to meals and entertainment for a minute, because what happened with that, or what is happening with that, and it still seems to be changing.
A couple big changes. So the first one is entertainment expenses, membership at a country club, or tickets to a baseball game. You can no longer. You used to be able to write those off at a 50% clip.
Not country club. Never a country club.
Never a country club.
No,
Okay.
Unfortunately.
So
But the other, yes.
the 50% deduction is no longer the case. You can't deduct it any longer.
It's a bummer.
Zero deduction for that.
Zero deduction. Business meals, where I take out a client or a prospect, and prior to this year, you could write that off at 50%. There was a little bit of folks in the industry didn't know if that was going to prevail because it was wrapped up in the entertainment expenses, but the IRS did come out and clarify and said that you can still deduct those at 50%. Now, if you're at a ball game and you purchase a hot dog and a Coke, the question is, can you write that off? Yes, if it's paid for separately or if it's itemized separately.
Okay, so you can write off the 50% of the food, but
food.
not the ball game ticket.
Correct.
Under any circumstances.
That's correct.
Okay.
Well, I mean, it's a gray area because people are looking at, okay, well, where does something fall into maybe a charitable contribution instead of entertainment expense, or advertising expense, or the rental of a facility? And so instead of having like 3 different categories, we've always broken those things out, like 100% meals, 50% M&E, and then 0% deductible. Now we've got like 8 to deal with, so it's lots of fun.
Yeah, it sounds like it. So what if you're courting the ballpark as a potential client?
Exactly. Yeah. I mean, we'll definitely see how that all kind of evolves over the next couple of years, what the IRS says about that. So.
Yeah. It sounds like that's a ripe area for a lot of case law.
Hopefully not for me. I don't want to end up in court about it.
Okay, we're going to take a quick break here for a very short commercial, and when we come back, we'll give you your second CPE code for this session, and then we'll carry on.
In your pursuit to deliver the best for your clients, we're by your side, bringing you the power of traditional pro tax software plus the freedom of the cloud. Your practice will always be there, already firmly planted in the future.
And we're back. So at the bottom of your screen, you should see your second CPE code for this session. So you want to make sure that you write that down if you're planning on claiming continuing education credit for this session. So you'll have 2 codes by now, 1 more to come. And let's carry on. We want to talk about changes in the law for like-kind exchanges.
What the government did was they retained the provision, and this is 2018 and forward, for real property, but they eliminated like-kind exchange or deferring the gain treatment for personal property. It would be vehicles, equipment, and furniture, that type of stuff.
Okay.
Yeah, so the vehicles is a bummer for sure. But what is neat is the new opportunity zone funds that come with a new tax code that can do similar to what the like-kind exchange does for you, but also offers some realized return in reinvesting the funds. Have y'all heard a lot about that?
We'd like to hear a little more about that.
Okay. Well, so the Opportunity Zone funds is any cap gain. So whether it's a stock sale, business sale, I mean, it could be any kind of capital gain. So it doesn't have to be real estate. You can defer it if you reinvest it in a qualified zone, which I think there's about 35% of the nation now or something has different qualified zones that you can invest in. And so there's all these people trying to come together to pull these partnerships together to invest in these areas and be able to defer those gains. And once you hit over certain time period marks, like 5 years, 7 years, 10 years, you can reduce the amount of gain that you have to recognize and even potentially eliminate it. Now the problem is that all the financial advisors I talk to, it's so new that everyone's flooding into the market, and so the return on investment in itself, without the tax savings involved, isn't really looking that good. And so I'm going to hold off for a bit until next year probably before I would recommend it to clients.
Now, can you give some examples of what you mean by investing in these zones?
So it's real estate opportunities in like weather-related destructive zones, like Florida, stuff like that, or just kind of lower income areas of different states.
Okay. Is it all real estate or? Okay.
Yeah,
Excellent.
it's all real estate.
Okay. And then what about net operating losses?
The change there is that they're now limited to, if you have a net operating loss, it's going to be limited to 80% of your income. Any part that you can't deduct gets carried forward indefinitely. They also eliminated the carryback provision. We used to take NOLs and we could carry them back 2 years. That's no longer the case.
Okay.
Two big changes on that front.
All right. Any planning opportunities associated with that? Anything different than what we've been doing?
I've been so focused on some of the other provisions, I haven't really put a whole lot of time or effort into that one. But again, with high net wealth clientele, I don't see the NOL that
losses,
often.
Yeah.
So it's not really my area of expertise.
Okay. All right. And then credit for employer-paid family and medical leave. What's that all about?
Yeah, it's a brand new credit on the books, and the way that works is that if you have employees that go on, it's under the FMLA Act of the Federal Act, Family and Medical Leave Act. If you're paying employees to go out on family and medical leave, then the employer gets a credit for covering them.
Yeah, I mean, there's a lot to that I have not unpacked yet. Is it 50 and over employees that applies to, or is it anybody?
I haven't heard that. A few of the details are that you have to have a written policy. They have to be out on at least 2 weeks of leave, and you have to pay at least 50% of their wage rate.
And then is the credit a percentage of what you pay them?
That's right.
Okay. All right. And foreign taxes.
Okay, I'm going to have to refer
Foreign
to
taxes?
Foreign taxes.
It's on the list that we all agreed on.
Yep.
Oh, that one.
I'm going to have to refer to my notes on this because it does get pretty complicated.
Yeah.
The bottom line is we're moving closer to a territorial type system. So there's no longer an incentive to stash earnings in a foreign subsidiary. You used to be able to do that and not get taxed on it. Under the new law, there's a low rate on these profits that are earned abroad. And there's also a one-time transition tax where you have these foreign earnings that were parked abroad, and now you're going to get taxed on those, even earnings that were in arrears.
Okay. All right. And can we talk about the new corporate tax rates?
Yeah, we moved to, believe it or not, we moved to a new flat tax of 21%. And that we used to have graduated rates up to, I think, 35%. Now we have a true flat tax in the corporate realm. And then a component of that, also the corporate AMT went away.
There's a lot of opportunity with C Corps. Over the last couple years, I was starting to move certain clients, if they had multiple entity structures, into utilizing the two lowest of the marginal rates in C Corps, 15 to 25%, if they happen to be in the highest personal tax rate or tax bracket. But now there's even more opportunity, and there's certain cool deductions that you can take in a C Corp that are difficult to take in other entity types. So it opens up the playing field to, I think, a lot more small business owners and medium-sized businesses to look at if, either converting to a C Corp is the way to go, or maybe adding that in as part of a bigger entity planning structure.
Okay. All right. We want to take another quick break. And when we come back, we're going to answer some of your questions. And we'll be back in just a little over a minute. So a quick word from Intuit ProConnect, and then we'll also have your third CPE code available when you come back.
The tax preparation business is no longer what it used to be. Whether you're a firm of 1 or 50. It's not easy to keep up. Tax laws change. Clients expect more, and oftentimes, their financial success is in your hands. But this is good, because you're a pro. It's not just about crunching numbers anymore. You're a trusted advisor who knows how to make the most of your time and resources to provide more value than ever before. And your clients love you for it. In your pursuit to deliver the best for your clients, we're by your side, bringing you the power of traditional pro tax software plus the freedom of the cloud, so you don't have to worry about security or IT headaches, and you can focus on what you do best, making a difference for your clients. Even as their needs and the industry evolve, your practice will always be there, already firmly planted in the future.
Hi, we're back. And at the bottom of your screen, you should see our third CPE code for this session. Third, right? Or is that second? Yeah, third. Okay. So write that one down along with the other two you've got. Those are the codes you're going to need when you go to get CPE credit at the end of the day. We're going to do right now kind of a case study on how the qualified business income, the QBI, is calculated and give you, we hope, a little more insight into how that's actually going to work since it's so completely new this year. And then after that, we'll tackle some questions. So Mike, take it away.
Okay, awesome. So qualified business income deduction, yes, very comprehensive. There's three basic limitations that we're dealing with. One is it's limited to 20% of taxable income of the individual. Then we also have a service business limitation as well as a wage/asset limitation. The second and the third are a little bit involved, so I wanted to bring up some slides and just walk through it for you. So the first one is slide number 5, and it's the one on the screen here. We have service business limitation. So if you're in one of these fields, health, law, consulting, athletics, financial or brokerage services, or where the principal asset is the reputation of the employer or the owner, you have these limitations. And we'll look at the 3 columns here. So for joint filers, and they look at taxable income, not adjusted gross income. If the joint filer is below $315,000, you don't have to worry about a limitation. They get the full deduction. And then on the other hand, if they're above $415,000, they don't get any deduction if you're in one of these service fields. And then if you're someplace in between, you'll get a partial type deduction. And then we move over to the second column, taxable income for other filers. It's basically half of what you have for joint filers. So that's how the service business limit works. Do you want me to run through the wage asset limit, or do you want to comment on this one?
Well, I do have a year-end tax plan I was working on just this morning for someone that did consulting services that it's pretty difficult to claim that they're not part of the specified service business category. And what my focus was to get them under that $315K taxable income. And there's actually a lot of ways that you can do that. So they were actually at about $450K taxable income. And so fortunately, they have extra cash flow, because you need extra cash flow to be able to put more into a retirement plan to potentially reduce your taxable income amount. Or you know, there's potential to carve out different entity types. His wife is actually a bookkeeper for the company, and so we were exploring if we could carve out some of the income and sales from the bookkeeper's role into a separate C Corp and have the first company pay the second company and reduce their personal taxable income as well. So there's definitely a lot of different avenues people can take, but that's where planning is so key at year end, because the wages and a lot of those opportunities are going to expire on 12/31. So.
Okay, so we'll move over to the next slide, which is slide number 6. The other big limitation here is the wage asset limit. And the way it works is the deduction of qualified business income cannot exceed the greater of these two amounts, 50% of basically W-2 wages of the enterprise, or 25% of the wages plus 2.5% of the unadjusted basis of the depreciable property. But then you say, well, when does that limitation kick in? And the graphic or the chart down below looks a lot like the one that we had on the prior slide. So if we're a joint filer, if taxable income is below $315,000, you don't have to worry about applying this limitation at all. And then on the other hand, if you're above $415,000 taxable income, you apply this limitation the way it stands right there. If you're someplace in between, there's a partial application of that limit. And then we move over to the second column, and there we have the phase-in, phase-out amounts for other filers.
So what's unique about this one is when I actually calculated this about a month ago, after I'd been training thousands of accountants on it, I hadn't really done a specific example of the W-2 limit. And what the software calculated at first I thought was wrong, because it's not just based on the W-2 wages or the unadjusted basis of the property. You can compare that back to the QBI times 21%, times 20%, I'm sorry, as well. And so it's not quite as limiting as you would expect it to be, but it's also something that, we are not going to be, doing backhand calculations on. And so that's where the K-1 information is going to be so vital to know about what's going on with the business. And it should be very similar to how the DPA deduction was reported on the K-1, right? Because it was based on that code to begin with. So.
Yep. And one of the call-outs here too, we talk about the three flow-through types of activities, mainly the Schedule C, the K-1 from the S-Corp, and the K-1 from the partnership. In this case, S-corporations can benefit with the QBI deduction in this realm because S-Corp would pay their principals W-2 wages, whereas with the Schedule C and the partnership, they don't pay their owners W-2 type wages. So depending on how the numbers fall, the S-corporation could be a preferable entity in this realm.
Excellent. All right, let's take a look at some of our questions that are coming in then. First of all, any speculation on why the entertainment deduction was removed? You heard anything on the story behind that?
The rationale, I don't know for sure. I think the government, it was a way of flattening out the base. They said, well, we're giving you a 21% flat tax, and we have this QBI deduction, and we're also going to take away some deductions that are, I don't know if they push the envelope as ordinary and necessary, but it was a way of flattening out the base, I would think.
Yeah, I would think so too. But yeah, I didn't really hear a whole lot of rumors about, where that stemmed from or why. There's been so many other aspects to focus on, and people have been looking at a lot of other pieces of it and getting upset about a lot of other things. So entertainment hasn't popped out quite as much as maybe it would have if it was the only change.
Right. I do have one more question here on entertainment, though, before we leave that topic. If you paid country club dues, but you're also doing meals there that are business related, can you still, as long as you've got that separated, can we assume that you'd still get that deduction for the 50% of the meals?
Yeah, if you have business intent for what you're doing at the country club, then yes, the meals portion of that would still be 50% deductible, yes.
Okay. Can you take bonus depreciation for an auto that's 90% use in the business?
Sure.
You're going to be subject to the luxury auto limits, but yeah, yes.
Okay.
And I think it's, yeah, you would.
Okay. Okay, you mentioned many small business owners buy their health insurance through some entity that doesn't qualify for a tax deduction. Why would a small business owner choose that?
Well, it gets them out of the penalty. So it does qualify as health insurance for not being subject to the penalty, but it does not qualify for the self-employed health insurance deduction.
Right.
So kind of two different aspects there.
Okay. Let's see, talking about a trade or business, do you think the taxpayer would be able to say a rental LLC reported on the Schedule E would be a trade or business for QBI only? Well, we talked a little bit about it depends, basically.
Yeah, I
is
think
the
they
answer.
could.
Yeah.
Yeah, I mean, I would put it 50-50 either way, depending on the circumstances and facts of that taxpayer.
All right. Or possibly change the rental to a Schedule C?
Are you allowed to do that?
Yeah, I mean, I don't know. That would be interesting. If you're like flipping short-term properties, you could report it on Schedule C. I'm not sure about moving an entire typical Schedule E rental situation to Schedule C just to try to qualify for QBI. That doesn't make a lot of sense.
Yeah. Okay, not sure where this is falling on the form yet. Do you reduce your income by the self-employment tax or a 401k deduction on a Schedule C and or your self-employment health insurance to calculate the QBI? So pension and
I believe they're
health
all
insurance.
going to be independent of one another. So the SE tax is not impacted by the QBI deduction,
Okay.
and the retirement plans as well. And just as a footnote, I'm not sure if we mentioned it earlier, but the QBI deduction is taken after AGI in arriving at taxable income. So those provisions that you mentioned, they're all they work independently.
Okay.
I think that might have been what they were asking is the half of self-employment tax on page 1 of the 1040.
Right.
So yeah, you just answered that with it's after AGI, so.
Okay. All right, excellent. Well, I will get the rest of these questions to you guys. We're ready to wrap up this session. Thank you all so very much. We certainly appreciate your time and interest, and we have one more session to go, so we hope you will stay. We hope there are plenty of 10-hour warriors out there who've been here all day. Feel free to let us know that you've been here 10 hours, either through Twitter at #DecemberCPE or email at info@ensuringsuccess.com. And we'll see you at the top of the hour with our final session on budgeting and forecasting. Thank you.